Yep, you're good.
Okay, very good. Well, hello, everybody, and thank you for participating in this important event. It's been a long time coming for Austin to get organized for angel investing, and I'm delighted to see that that we are there. So, some of the points that Sean has just made will probably be reiterated again in the next 10 minutes. So, I'm going to essentially tell you everything you want to know about angel investing in 10 minutes. Ha ha ha. So with that, go to the next slide, if you would, Sean. So here's what I want to cover in 10 minutes. But basically, what is angel investing and why should you consider doing it? What is the process that you go through, and how do you create an angel investment strategy and portfolio that works for you? Next slide. So angel investing is really a process by which you bring to the table risk capital to support development and launch of some sort of disruptive technology. And whether it's disruptive because it's intellectually different than other things have been created, or because it's a new idea that others could do, but this is somebody who's first to market with it and has a advantage because they know the industry well. It can be all kinds of different reasons. But the important part of it is that it's risk capital, not growth capital, not exit capital. It is the early capital. It's often made after the entrepreneur has tapped out his or her own funds and have tapped out the funds available from the nearby friends and family who the entrepreneur often taps to invest. And in most cases, this is usually a pre or very early revenue company. And it would be highly unusual that you would be asked to invest in a company that is already profitable as an angel investment. Next slide. So why would you bother to do this? Well, some of it can be because you actually think that this is a good thing to do. You think the technology at hand is kind of cool. You want to be part of cool and new things, and you just desire to see new technologies come to market, and so you want to participate for that reason. But most investors want to participate in angel investing because they want to make money, and that's not a bad thing. The typical angel investor has or should have in their mind that the investment that they're proposing to make has the potential to make them 10 times their money over some period of time, and we'll talk about what that period of time is coming on up. It's not to say that you will make 10 times your money in any particular investment or in any investment that you choose to make, but for the most part, if you don't think you can make 10 times your money in a particular investment, it's probably not the right angel investment to make. And of course, another reason that you may decide to do this, as I say, is supporting your neighbors or friends, or maybe you've been an entrepreneur yourself and you found others invested in your deal and now you want to give back and do the same. Next slide. So, of course, now we're talking about investing in the time of the pandemic. And, and I will tell you that in the Twin Cities, where most of the angel investment activity is occurring in the state, angel investors are continuing to be active in looking at deals and investing in deals, even through the COVID-19 shutdown that we've had. There's no doubt that there's probably a 25% year-over-year reduction overall in the dollar amounts that seem to be going into companies, but there have been a lot of companies historically that have started up during recessionary times, and when times get good, they suddenly burst out and are doing well. And of course, they get the moniker saying that they were an overnight success. And of course, they oftentimes started in rough times, but they were quiet and moved along through the process. So in thinking about things, it's not unreasonable, however, in this particular time to think about, is the investment that you're considering something that will work in today's environment, and how you think the world will evolve. If you think that, in a simple example, that people are going to increasingly work from home and not in office spaces in downtown areas where they're brought together, then of course investing in downtown real estate might not be a good investment. Not that that's necessarily an angel investment, but the point is you need to think about what are the things that probably make sense in the world going forward. Will they survive in an environment that's either a downturn, or that the way that business is done is is different, as we are starting to see. Next slide. So the angel investing process, of which you've kind of heard pieces of there from Sean, are you need to obviously identify what kind of company you're going to invest into. You have to screen them to decide if they fit basically what you're interested in. Does it from an industry perspective work for you? Is the company far enough along in their development beyond just an idea or a business plan? Have they got a prototype that they can show you of what it is that they're proposing to do? How much money do they need? And how much money in total are they raising, and what's the minimum investment that you have to put on in? Well, all those things could play into whether or not this is even an investment that you should be considering at all. You'll then listen to the entrepreneur's pitch. That's going to happen this evening with 3 companies and some initial Q&A. And then you have this process of investigating the business, the people, and the opportunity to decide, is this thing for real? Alone or with a group, you need to negotiate what the economic terms and conditions are of your investment. And then my preference for you all would be to see that you, generally speaking, invest as part of a group as compared to investing as individuals, because there's strength in numbers in that sense. Next slide, and we'll go through each of these. So the identification and screening process, well, of course, your friends, your family, business colleagues may come up with ideas for you to hear and listen to that they think either they're starting on their own, or that they've heard about, or that they've think is interesting. Angel investment groups, such as obviously the participation here with Austin Area Angels, opens those opportunities. There are lots of other groups in the state of different sorts and sizes. Of course, again, a lot of them are in the Twin Cities. I actually run one called Angel Pollination, which is a quarterly get together of angel investors, and I bring 3 presenting companies and a speaker together each quarter. Although we didn't have our April event and we won't have our June one, but we'll probably do something online here, and hope that by the time we get to the fall for what is typically an October and December event, that we'll be able to have them live at Interlochen Country Club in Edina, as we've done for the last 10 years now. And there are things called incubator programs, which are basically programs that come together that are usually in some sort of co-working space where there is mentorship, a little bit of investment, and a lot of coaching and introduction to investors and business people and prospects to basically increase the likelihood that a company will be successful. And coming out of that, typically those programs will profile the companies that they have selected, and those can sometimes be good potential opportunities to consider for investment. Obviously, if you talk to investors who are already in an investment, they have lots to say about whether or not there's been progress that's been made since they invested and what they think of the management team. So that's certainly helpful. And most importantly is looking for early reasons not to invest. The best decision you can sometimes make in angel investing is to decide not to do it. And yes, it will mean that along the way, something that you passed on will turn out to be the big home run. And I'm sorry, that's just the way of the world. Next slide. The investigatory process. You heard the reference to due diligence, and that's really what it's about. Most of your, the last point on this slide is the most important one. Many deals stop here. They don't pass muster when you get in and start testing out the theory of what the entrepreneur has presented to you in their pitch deck that they will present to you this evening. But it starts with the presentation and the Q&A, and you start to think about things and you start to ask questions. And then hopefully as part of a group again, it can be done individually, but it accelerates things in a group to investigate the team, because in a young company, you're mostly investing in what the people can do and their background and their ability to manage their way through what undoubtedly will be a bunch of change along the way. And you're interested in their experience in the industry that obviously they're going to participate in. And then you want to look at the business. You want to look at what kind of technology protection is there. Are there patents? Are there trademarks? Are they first to market? What's the theory of why it is somebody else can't simply go do this? What's the market opportunity? A lot of investors really aren't interested as angel investors in investing in things that don't have, well, venture capitalists want to invest in things that have $1 billion market opportunity or greater. Angel investors will sometimes consider things smaller, again, if it's right-sized, because again, you're thinking about, can I make 10 times my money on this opportunity? And if the market's too small, that may not be available. You're interested in who the competition is. You're interested in knowing how far along the company is. Early on, as I say, it may be that they've got their first customers, or it may be that they've just got a prototype, or they just at an idea stage, in which case it's tough to raise money, as an entrepreneur, and tough for you as an investor to get comfortable with that. And then you want to think about how do they get an exit. In days gone by, exits for a lot of my clients used to be public stock offerings that created public trading markets where you could sell your stock, but that's really gone away, and now it's all about building companies to sell them. And so you're interested in thinking about who could potentially buy this down the way if they're successful. Next slide. So you get through the due diligence process, and then there's the issue of actually negotiating an investment deal itself. And in early stage investments, often the investment is either common stock or convertible debt, although preferred stock is also useful as well too. And of course, if the investment is in a limited liability company, it won't be stock, it would be membership interest in an LLC, and it's beyond the scope of what we're going to talk about today of what the difference is between investing in a corporation versus an LLC and what's good or bad about each of them. But a common stock, of course, is usually what founders have. It basically says one share, one vote. And so, and one share participates equally with others in profits and losses. Convertible debt is really a concept that says, hey, we can't come to agreement early on here how much the company is really worth. So I'll tell you what, I'll give you money today. It'll earn some interest rate on it. My intention is I'm never going to get that note paid back. But if sometime between here and let's say 2.5, 3 years from now, the company does a priced round of financing, prices the stock or the membership interest that it's selling, my loan and the interest that accrued on it will automatically convert, as long as the round is at least somewhat big enough, into the equity security that's sold in that priced round, but I get a discount because I came in early. So usually the discount's 15 to 25%, 20% is pretty typical. Oftentimes on these terms, the lead investor, i.e. the one who's likely to put in the most amount of money, sets the terms, and then companies will typically say, well, our terms are set by our lead investor. And so you may have to make a decision whether or not the lead investor has other motivations for agreeing to particular terms that you don't agree with, or whether or not you can succeed based on the amount that you or your group want to invest. Can you get additional or different terms? Many angel investments are based on company valuations that are under 3 million. And we have seen in the pandemic that valuations have probably come down 25% or so. We'll see how they handle going forward. Okay, so here we are in terms of the slide on angel investment strategy. And what's most important is this is an asset class, and the asset class starts with the issue of should only invest what you can afford to lose. Angel investing is not for the risk adverse soul. You should not count on this as paying your money for your groceries or your mortgage or anything of the sort, because you're going to be waiting a long time for an exit. We used to think that exits came in 2 to 3 years, and then it was 3 to 5 years, and then it was 5 to 7 years, and now I truly think it's 6 to 10 years before a lot of companies. There are always exceptions, but a lot of angel investment is a long-term play. So you set your total investable capital for this asset class, and then you pick a target amount of investment per deal, 10,000, 15,000, 25,000, or 100,000, whatever it is. What you're going to do is consistently invest that into each deal that you decide to invest into. But you always be sure to save some powder so you can invest in the same company in their next round, probably at a higher valuation, but based on the fact that the company is showing promise towards their success. And so you don't put in more money towards the companies that aren't going towards success, and you put in double down, so to speak, on the ones that are. And you, in the end, in creating a portfolio theory, it's good if you do more than one angel investment and you do it in more than one particular industry, just so that you have the opportunity across the board. You can usually think about the fact that out of 10 investments, 5 of them will go out of business, and you're going to make your money on the other 5, and most of it's going to be made on 1 or 2. So that's kind of the way it works. Next slide. That is, probably the world's, fastest look at angel investing, but you always have to end these things with a cute puppy. So this is our grand dog Bowser, who's a Great Dane, and as you can probably imagine, this having been taken a few months ago, he's much bigger now. So as I say, I do run an angel investment group, Angel Pollination, which I will certainly talk to Sean about, inviting you all to our next events. And of course, my day job is I work with entrepreneurs who start and grow technology companies and investors who invest in that kind of thing. And I'm with Advise and Legal in Minneapolis, and this is my contact information. And yes, I grew up in Austin. So with that, Sean, I'll turn it back to you.